She is honored to be the inaugural director of the Office of the Homeowners Association Ombudsman. Prior to this role, Erin spent the last several years working in corporate law, handling matters of corporate governance and negotiating complicated mergers and acquisitions for her clients. Prior to her time in law, she worked for a healthcare startup in South Jordan, managing large sales teams in Salt Lake and Dallas, Texas. And she's a native of Mill Creek, where she currently lives with her dog, a mini Bernedoodle named Penny. She graduated from BYU with her bachelor's in business management and an emphasis in entrepreneurship, then went on to receive her JD/MBA from Georgetown in Washington, D.C. While in D.C., she also spent time on the Senate Finance Committee as a law clerk, participating in tax reform discussions prior to the tax reforms implemented under the current administration's term. After graduating from Georgetown, she moved to Boston and began practicing law at Goodwin Proctor, and in 19 moved back to Utah and began working for Dorsey and Whitney in their corporate practice. She's excited to bring her experience to this new office and to answer all of our questions today, and to make a difference for homeowners and professionals in the HOA industry. So let's please give a warm welcome to Erin.
Okay, let's try this.
Okay.
Also, as a note,
I don't think it's plugged in. Hold
you
on.
guys, this worked. Oh, it's not plugged in. Okay, first we gotta plug it in. As a note, she is good with us sharing the PowerPoint for you afterwards, so you don't have to take pictures of everything. Caitlin, why doesn't it work?
Come on, Chris.
Is that okay?
Yeah.
Sorry. Okay, all right. Another warm welcome for Erin, now that we're back.
This is why you bring people from your office with you so they can run the PowerPoint. This is Chris. He's our staff attorney in the office. So Chris and I are both attorneys. He writes our opinions and does a lot of trainings for boards and homeowner groups. So he is here today to help make sure that I say things correctly and to help answer questions where necessary. And we're going to hope that this works. Do we need to try?
It should pop back on.
Okay.
There we go.
Okay, let's just redo this again. How many of you like HOAs? Like, how do we feel about HOAs in the room? Who are you the problem child I have to be mindful of? Yeah. Like who?
I don't like them.
What has been your experience with HOAs? Tell me just a little bit about, yeah.
They don't respond, and when they do, they won't be paying money for them just to send a simple document over.
Okay.
Some of the transfer fees are out of control too.
Yeah.
I mean, it can cost $2,000 to transfer HOA fees.
Okay, all right. So response time, access to documents, transfer fees. Okay, yeah.
Increasing fees constantly.
Okay.
No, we don't have any limits on what those increases can be.
Okay, all right. Increasing fees, yeah.
No accountability on what those numbers look like. If a townhouse is resold every 2 to 3 years, 2,000 homes in one HOA with a transfer fee of $2,000, you do the math. Where the hell is all the money going?
You are the passionate one. Okay, yes.
There was a spotlight article on KSL TV last week. You may have been part of that, talking about.
Yeah, Matt Gephardt. Mm-hmm.
And the thing that was most disturbing was the part where they said some of these HOAs do not have enough in financial reserves to cover major problems, and when they come up, they're charging homeowners thousands of dollars.
Yeah. Mm-hmm.
That's a problem.
Yeah, in the back.
Well, as Sean was pointing to his point, I love my HOA. Fantastic care, takes care of things, on top, clean, fantastic, great. Until they slapped a $5,100 lien for assessment. And I'm like, wait, I'm paying $350 a month here. Why is that even necessary? I thought those things were covered. And these reassessment fees, I don't know if y'all have been in the business, but 20 years ago, you didn't see that. They didn't have these reassessment fees all the time. It seems like it started about when Daybreak was put into place, and there was a big reinvestment issue on that, and it seems to have just been acceptable all of a sudden. And I was really upset. I love that HOA. It's the only one I can say that about. It's the only HOA that doesn't
Okay. How many of you live in an HOA? Okay, we've got a few, not too many. Or own property in an HOA, I guess. Okay, more, all right.
We're close.
I'm doing a really good job of stalling.
Fantastic. Right?
I bet you didn't even notice that I was stalling, trying to give them time here. So what I want to do today is, you guys are actually the first group of mortgage professionals that we've worked with. The way that our office works, we get a lot of questions from real estate professionals, obviously a lot of questions from homeowners and from boards, attorneys, managers, people in this space. We're starting to get more and more calls from title companies, but we haven't had too much interaction with mortgage professionals yet. So this is going to be really helpful for us as well, hopefully for you, because we're going to hear the things that are on your minds and where you have concerns in this space, which is going to be helpful as we talk with the legislature and we're looking at the law and kind of how this industry is working. So what I want to do is go through the basics. What is an HOA? How are these things actually set up? How do they run? How do the finances work inside an HOA? What are some things at closing that you need to be thinking about? Fees, things like that. And then kind of where does our office come into the mix here? Has anyone seen a presentation given by our office yet? One, okay. Okay, great. So let's start with what is an HOA? So the idea of an HOA, it's a legal entity. You don't actually have to be set up as a corporate entity, but most are. Most are set up as nonprofit corporations, and that sort of sits over the whole thing, and it's a shared community. There are two laws that govern HOAs in the state of Utah. Did you guys know this? Two separate statutes that govern HOAs. There's the Condo Act, which governs condos, and the Community Association Act, which basically governs everything else. This is actually a bit of a pain point because we get a lot of phone calls from people who think that one statute applies to them and it's actually the other one. And they're not identical. They don't all have the same rights and responsibilities in them. So you gotta make sure you're starting with the right statute because the requirements may change depending on which one you're looking at. So the way that I like to say this is that when you are buying in an HOA, it needs to be a paradigm shift. You're not just buying that house, you're buying the whole community. That means you have a financial obligation and responsibility for covering the whole community. You are a joint owner in every piece of common area with every one of your neighbors in that community. And that mindset can do a lot to change how you think about HOAs and the risks and responsibilities you're taking on when you buy into that community, because it's the whole thing. Okay, so why does it matter for you? Because we're talking about financial health of an HOA. We're talking about fee obligations. We're talking about reserves, which we're going to come back to reserves. All of those can affect someone's ability to qualify for a loan, right? And so we're going to talk about this as we go throughout the day and discuss how this affects you and what you should be looking for and things to keep in mind as you're working through this. Okay, this is how HOAs can be structured. Okay, can be structured. Not all of them are structured this way, but they can be structured this way. Some terms to keep in mind. Does anyone know what a PID is? Nope. Okay, a PID is a public infrastructure district. One of the challenges we've had in the state of Utah is how do we keep up with the rate of growth in Utah, right? How do we keep up with the need for more housing when the cities are in a position to say, if we take on more bonding, more debt to build infrastructure, that's going to tank our credit ratings. It's going to affect our ability to bond later on and to do the things we need to do as a city. But we need to grow faster than the cities can keep pace. So one of the answers to that has been public infrastructure districts. These are essentially private entities that allow the developer to go out and get a bond, and then the developer creates an entity and that bond sits over that community. So a place like Daybreak, I think Daybreak has a PID, but you see these big, huge communities and that PID sits over the whole thing. And a PID, what it does is it basically takes the equivalent of a mortgage and attaches it to the homes for the length of time necessary to repay that debt. So in addition to your mortgage, you might have a PID payment that also sits on the home that's part of the homeowner responsibility to pay back that debt. Now, a PID is different than an infrastructure financing district. An infrastructure financing district is the same concept, but what it does is it requires the debt to be paid off before the homes can be sold. So the first people who go in, you basically have to raise the amount of the price of the home to pay off the debt right from the get-go, right? So the difference is when the debt gets repaid. A TIF is more of a municipal issue. That's a tax increment financing, and those work a little bit differently. But those are kind of the mechanisms that the state is looking at right now to figure out how do we build infrastructure to facilitate housing development. So if you live in one of these communities, you have the PID that sits over the whole thing. You likely also have what's called a master association. And a master association, again, think about a place like Daybreak. A developer will go out and get a huge piece of land and put a master association over the whole thing and say, okay, over the next decade, we're going to build this community out, and here's the master association that kind of governs the whole thing. And then as they build out little communities within that master association, those are sub-associations that get put in there with it. And you may have mixed-use HOAs that go in there. So in Daybreak, they have the Live Daybreak stuff, all the commercial developments, right? So if you buy into Daybreak, you probably have at least 2 HOAs that you have to pay fees to, because both of those HOAs, the Master Association, the sub, and maybe there's a third one in there too, each one of them has a fee that you pay to. And then if you have the PID, you also have a PID payment, and that all sits on top of your mortgage, okay? So that's how these things are structured. A large master plan development, we'll come back to this in a little bit, but the basic idea here is that large master plan developments are carved out in statute in certain ways. They're basically 500 acres or developments with 500 units or more. So these are big areas where we're giving special consideration to facilitate development. Okay, that makes sense to everybody? This is the groundwork that we're gonna start from. Okay, so who owns what in an HOA? Super important, and we're trying to help people understand when you buy into an HOA, what do you actually own? So there's a difference between private property, common area, and limited common area. The private property is the stuff you actually have a deed for, right? That could be your lot, it could be your condo. Sometimes it's the house, but it's not the lot, right? So you actually have to look at the deed and figure out what do you own when you buy in there. Common area is owned by the association and maintained by the association. Private property, you're in charge of maintaining. But common area is owned and maintained by the association. So you have a partial ownership in that common area, but the association is responsible for maintaining it. And then limited common area is also owned by the association, but is set aside exclusively for your use. So that could be a balcony on a condo. It could be a driveway on a townhome. It could be the lot. If you don't actually own the lot, you might own the house, and then the lot is limited common area. So it's reserved for you, but you don't actually own it. Okay? Questions? Feeling good about this?
Like a mobile home. That's not.
Not exactly. But I appreciate the attempt. Yeah. Yes.
It's a mobile home with the foundation.
Mobile homes are different in that you usually have to rent the land underneath the home, right? And so those are in a totally separate category, and we actually don't oversee those at all. But the concept, yeah. So not really, but thank you.
The concept where you don't own the land, when you look at the deed, it's a leasehold interest, it's not a fee simple interest on your home, is that right?
No, so it would actually be set up, these are designations in the CC&Rs. And so when you own the deed, you want to look at how that, like what's actually on the plat and the property, right? But you want to look at the plat for the development, and you want to see, they usually have it designated, this is common, this is limited common, this is private property. So you want to actually look at that and see. And that matters because under statute, if you have rights according to your lot, but if your lot is not your yard, then those rights don't extend into your yard. Okay? Okay, let's keep going. Food for thought. Should common area be included in a home inspection? Right? You own part of it if you buy in. So should you be inspecting the pool? Should you be inspecting the clubhouse? Should you be looking at the condition of the roads or the other things in the home, right? Again, like you're gonna own it, and if that pool has a big old crack in the foundation, you should probably know that because that means a special assessment is coming. So anyway, just something to think about there. Okay, how does an HOA operate? Before I move on, any questions about structure, kind of how they're set up? No? We good? I'm not losing you? Okay. All right, how does an HOA operate? Here is the hierarchy of what governs in an HOA. At the very top is the law, right? So you have federal, state, and municipal law. That trumps everything else if it wants to. Next is the CC&Rs and the plat. Then you have the articles of incorporation and the bylaws. So if it's set up as a corporate entity, a nonprofit corporation, those come next. And then the rules and the regulations are at the very bottom. So you think about this in terms of what is recorded. You have state law, the CC&Rs and the plat are recorded with the county. The rules are not. So the CC&Rs are going to have higher priority over the rules. And the things at the bottom cannot contradict things up above. So that's the way to think about the hierarchy here. And then how is it run? I think everyone knows this. There's a board of directors or a board that's usually elected by the homeowners. Many HOAs hire a professional manager to delegate the day-to-day tasks of running the HOA. And then homeowners usually have the right to attend meetings and to vote on certain issues. So basic premise here. Let's get into boards versus managers. Do you guys have questions about the difference between boards versus managers or anything relating to that? No? Okay. Then we'll go over this quickly. So the board, again, the board is ultimately responsible for what happens in the association, but the managers often handle tasks for the board. Now this gets really interesting when we start talking about things like transfer fees, because who is imposing the fee? Is it the board that's imposing the fee, or is it the manager that's imposing the fee? And there are some interesting legal implications if the manager is imposing the fee that the board has not actually approved. Okay? Okay, let's keep going. So finances. Let's get into the finances of an HOA. Regular dues. These are monthly, annual payments. They cover the operational costs of the HOA. Things like landscaping, the management fees, basic things like that. These assessments are actually debts under the law that are levied against the homeowner, and they sit on the home as long as that person owns the home and that HOA is intact. So it's a collectible debt, meaning if you don't pay the assessment, the association can come after you and impose additional fines and potentially foreclose on your home. So that's the teeth to make sure that all of this runs. How does that differ from special assessments? Special assessments are usually one-time payments that are charged for things that the budget can't do on its own. So these would be unexpected costs if there's a lawsuit and they have to cover the cost of attorney's fees. That's where this would come in. Or major repairs that they haven't planned for. It can result in a lien if a special assessment is approved and you don't pay it. That can result in a lien, which can lead to foreclosure. But they usually have to be approved by the members beforehand. We actually had an opinion come to us. A guy was in an association. They needed to charge a special assessment. They were breaking it into two $500 payments, one in 2024, one in 2025. Everyone in the neighborhood, in the community approved it. And then in early 2025, so everyone paid in 2024. In early 2025, the board president came out and said, hey, we're fully funded. Our reserves are fully funded. Go us, like we're doing great. And this homeowner said, well, if you're fully funded, why do I have to pay the second $500 payment? I shouldn't have to pay that if we're fully funded. And so he came to us and said, I don't want to have to pay this second $500 payment. And we said, actually, there's no cap on how much you can have in reserves. The fact that your HOA happens to be fully funded is kind of rare and really good. Like that's a good thing. And the homeowners approved the special assessment. So even though you don't want to pay it, it was approved by the homeowners and you are still obligated to do so. Okay, reserves, yeah.
So under special assessments, you're saying unplanned for repairs, right? But they put special assessments for a roof. Well, that's a plan. I mean, you know there's going to be a roof replacement. It's going to happen in 20 or something. How is that unplanned?
Well, so I guess the other thing I should have said in here is if an HOA is not properly financed, then they may have to resort to special assessments. And I think we're actually going to get into this in the next slide a little bit, but there's a real issue and a real tension in an HOA. The board doesn't want to be in a position to raise dues. I mean, this is municipal government, right? Your city council members don't want to raise taxes. Nobody wants to raise taxes. Nobody wants to raise dues. But if you're not raising dues and you're not putting money aside into reserves, then you might know that the roof is going to need to be repaired in 20 years, but you're just like, the people who live here in 20 years can deal with that. I may not live here in 20 years, so I don't want to pay for someone else's roof to be repaired, right? But then when that roof bill comes due, well, now you have no choice but to issue a special assessment because you can't cover the cost otherwise. So there's a real tension here for boards where they have to be looking down the road and saying, we know that these costs are coming. How do we make sure we have enough set aside to handle that, even though we know that if we raise dues by too much too fast, it might actually be not financially feasible for the people who live here to pay it, right? So if you're paying $350 a month for your HOA, but it really should actually be $500 a month, you might actually force people out of the community if they can't pay that. That's a real tension. But that is where reserves come in, right? Reserves are supposed to be the savings of the community. They're supposed to be set aside and deal with common areas and facilities are going to need repairs long term. So we had an opinion come in from Black Bear Condominiums up in Summit County, and the board had been artificially depressing the dues to keep the dues low, and everyone in the community had just decided, yeah, we'll just deal with things by special assessment if and when they come due. Well, the roofs needed to be repaired, and all of a sudden, $65,000 special assessment on condos. That was for a single unit. I think a double unit was like $105,000 for like a double unit. And everyone in the community approved it. And this homeowner came to us and said, they have been negligent. They should have been putting more aside in reserves because now I'm stuck with a $65,000 special assessment. And we said, yeah, that's how this works. So this is a real big problem. We've had other people call in $100,000 special assessments. I mean, it's a big problem. The other option, if you have an HOA that gets underfunded, is they can look at taking out a loan. Banks love HOA loans because they're collateralized with the property in the association, and they always get repaid. But what happens in the process of repayment is that those assessments usually have to go up to cover the cost of repaying the loan. And sometimes that means you are literally forcing people out of the association because they can't keep up with payments, even though the loan always gets repaid. So what's required in a reserve analysis? They have to be done every 6 years, and then they have to be reviewed and updated every 3 years. There's not actually a minimum amount required to be put into reserves in the state of Utah. No state law requires a certain threshold. It's a standard of prudence, so whatever the board deems prudent at the time. And, here we are. Anyway, so
Non-condo HOA.
this is for every HOA.
Oh,
Every HOA has to do the reserve study every 6 years and review it every 3. And that prudence standard is the same. Now, that differs from Fannie Mae and Freddie Mac. You probably are all familiar with the recent bulletin that came out on this, right? Now there's a little bit of tension here because state law does not require what Fannie and Freddie are asking for. So we're going to see how that plays out. And one of the things we've been trying to do is to educate boards to say, if you want to qualify for FHA financing, if you want access to some of these lenders, you have to be putting more into your reserves. But we may see a number of condo associations in particular lose their FHA financing status because of these changes.
What percentage difference is there between prudence and what the FHA?
There's,
I'm just saying, how far off are they?
totally depends on the association.
Have an idea. Wow.
Yeah, it just completely depends.
It's Utah's in for a big surprise.
Yeah, see, that's not, that could be an issue.
But then you're gonna see HOA fees going up because
Yes.
they're
Yeah,
counting
no,
these reserves.
yeah,
Right.
but then if you don't address it, then it just goes up to the point where it breaks, could break. I mean, it could really.
So back
be
to
a problem.
affordable housing
Yeah.
options in
Yeah.
Utah?
Mhm.
Well, and
You can see how we're going in a circle around this, right? Yeah.
Who can't afford the special assessments and
So
they can't
true.
afford it.
Yeah,
Like,
it's better to pay the payment
First time home
than
buyers.
deal with the assessments.
Yeah.
Yeah, so we have, did I put Field of Dreams in this one? Okay, I'm gonna save this example here for a minute. But you can see the problem, right? Like you can see how this just sort of perpetuates, and we get into a situation where we're like, okay, how do we deal with affordable housing? How do we deal with the rate of growth? How do we help people get higher, higher density often means lower mortgage prices, but we're also sort of shifting the costs from here to here, and we're not always being transparent about what this means if you're unaware. So it's a big challenge. Any other thoughts on this before we move on?
Troubling. To answer his question, the difference between Fannie and Freddie's 15 and what most are doing, 8 to 10%. Most are about 5 to 7% is what's actually getting.
So it's not that far off, if they wanna kind of.
That's a lot. I mean, yeah, I mean, if your reserve fund says you need $3 million,
Yeah, it's not good.
that's right. And we actually, we do have a lot of boards who will come to us and who will say, okay, how much do we actually have to put into that? Like, do we really have to follow what the reserve study says? And we'll say, well, the state law requirement is prudence. You have to make the decision, you have to be prudent. But if you are not following what the reserve study says, then, and there are times when they'll say, well, the management company did this reserve study. We don't know if we believe it. So we don't know if we want to follow that, because that would mean that we'd have to increase fees by so much that people can't afford to live here anymore. So we can't do that to our neighbors. And then, right, again, you see how this just sort of goes in a circle. So one of the...
They won't be able to sell it.
Liquidity is
Because
hard.
they can't
Right.
meet, so I don't know that current homeowners understand that, because yes, you don't want your HOA fees to go up because you can't afford to pay them, but eventually your goal is to get out of that home, and then no one can qualify to buy your home.
Right. And I actually had a broker call me not long after we opened, and he said, I've been trying to help a client buy a condo. We were looking at this condo in Sandy, and it was a multi-building community. And one of the buildings, not the one that they were looking at, one of the other buildings had some pretty serious structural repairs that needed to be done. It was going to cost like $100,000, I think, to fix them. And the mortgage companies came in, took a look at the reserves, took a look at the minutes, saw that they'd been talking about this, and wouldn't back the loan. And so they walked away from the transaction. But what that means is that seller can't sell their property, right? Because you're left with a cash buyer at that point.
So I feel like that's a conversation with HOA boards to their members to
Yeah.
say, hey, we understand this hurts, but also this loan won't be eligible for anyone other than a cash buyer to come in and buy your home in the future.
Right. And we see this, this is a big problem in communities where there are a lot of investor-owned units, right, where you have a lot of rental units, because the investors, the owners, don't actually want to pay more in the fees, and getting them on board. We've had boards come to us and they're like, we cannot figure out how to increase anything because the owners won't do it, even though they don't actually live here, and they can't see that the pool needs to be redone. They can't see that the roads need to be repaved. And so that's the argument we've been making to them is, okay, well, you need to help these investors understand that if they ever want to sell this property, they have to put the money in to make sure that it's where it needs to be. Otherwise, their investment becomes worthless in some ways, right? Like they can rent it out, but over time, that's going to diminish. So it's legitimately a big problem. Okay, other things to think about. Oh yeah, I did put it in here. Deed restricted lots. This is another one where we're starting to see cities do this more and more in the theme of affordability, right? So they're restricting rental development that was just announced in Salt Lake City between Garbett Homes and Homium, I think. And the way they're going to do this is they're going to provide like a silent second mortgage that sits on the home, and it stays there with each new owner that comes in. And that will allow the mortgage to be less, but they're deed restricted lots. And so only certain people can actually even buy them. So anyway.
Certain people being primary owners?
Yeah. I think so. I think so. Yeah, so yes. So it's income driven, right? So if you want to buy into that neighborhood, they're going to be looking at, yeah. Okay, we've already talked about association loans. We've talked a little bit about FHA qualifications. So let's talk about low-income housing options. This is kind of where the HOA model really starts to break down in some ways. I do want to clarify, I'm not anti-HOA, but what I do want to do is highlight where the challenges are so that when you guys are doing your work, you know what to look for and what to watch out for, okay? So, Habitat for Humanity bought a baseball field in West Valley several years ago and decided to build a low-income housing development on it. They called it Field of Dreams. And there were news articles about this development when they did the groundbreaking, all this great stuff. They built it as an HOA. And it's twin homes, attached twin homes with a private road and I think maybe one, like a single water meter going in, and then a green strip, like a park space. And their model, Habitat for Humanity, is that you come in and you put in some sweat equity and help build the homes yourself, and then it's income driven, right? And so they're looking to bring people in, they're trying to help people get home ownership. Really great model, really great plan. The problem is, as people started buying the homes and coming into the homes, they kept the fees depressed. And so they were only charging $10 a month for the HOA fees, partly because they were still building out this green space. This is an AI generated image. We're very proud of it. Not the real picture. But the green space they hadn't built, and so they were like, why would we charge people the full amount of the fees? We know these are lower income families anyway. Why would we charge them the full amount if we haven't finished building out the whole development for them? Totally understand the thought process. But over 10 years, you had a number of people who got really used to paying $10 a month in their HOA fees, not realizing that Habitat for Humanity was subsidizing the rest. So Habitat for Humanity finishes development, hands it over to the community, and now there's a new board that's suddenly looking at this saying, wait, we need $150 a month in fees, not 10. And so we've now had multiple phone calls from the board. We've done multiple trainings with the board. I think Chris is going to go do one, next week? Like our 4th training. And the homeowners will not agree. They just keep going to the board and saying, go back to the old budget. And the board saying, the old budget was a fiction. It was not a real thing. And they said, well, then we don't want an HOA. Well, you can't just choose, like that's not how this works, right? So now we're talking to the board and they're saying, what can we do? How do we do this? Because they all have shared water. And who's paying the water bill, right? It's been the board treasurer who's been footing the bill for that herself. Their insurance, their association insurance policy, who's paying the premiums on that, right? The board has been covering the cost of that. And so now we're talking to them and saying, well, the way this works is if people won't pay their assessments, remember what we said earlier, they're a debt against the home, you can go down the path of foreclosure. But now we are talking about foreclosing on low income, often immigrant families for whom these homes were built, right? So anyway, again, just red flags to think about. Okay, let's talk about insurance for a second. We had a great intro to insurance. Yes?
I think maybe an important note on that, when they're foreclosing on an HOA lien, it's still going to be subject to the mortgage.
Yeah.
It's on that property. It's not like the HOA gets to take the property free and clear.
Right. Well, and in this Habitat for Humanity one, the way that they work, they also have a silent second mortgage that sits on the homes. And it's forgiven if the homeowner stays in the home for like 15 years or something. But if the association, and I talked to the CEO of Habitat for Humanity about this because I called and I said, tell me what's going on with this community. And she said, we have done so many trainings. We sat down with every homeowner. Like, this is not the fault of Habitat for Humanity by any means, right? This is just, anyway, higher level, big picture here. But if the board had to go down the foreclosure path and the mortgage were paid off, the silent second would also have to be paid off if you're before that time of loan forgiveness, in which case the homeowner is going to walk out with probably nothing. So Okay, so insurance, the way to think about insurance in an HOA, two different types, two different levels, right? You gotta have an association master policy that covers everything in the association, and then the homeowners themselves also need their own policies. So the HOA has to have your basic property and liability. They've got to cover all of the dwellings, common areas, all of the original, the fixtures, all that kind of stuff. It has to cover everything in the association. And the homeowners need to pay for that. Now, we have seen big problems where associations are kind of like, why do we have this policy? Get rid of it. Like, costs that we don't need, let's just bring down costs for everybody. So they let it go. They let it lapse. And in an environment like today, when they go try and get a new policy, they really, really struggle. And so some of them are looking at catastrophic coverage only or different things like that because they can't get a new policy again. But insurance premiums are going up like crazy, especially for people who live in high-risk areas like wildfire areas. Getting a master policy for an HOA, that costs a lot of money. Like, that is a huge expense for the association. And then on the other side, the homeowners get what's called an HO6 or an HO3 policy, and that covers their own personal dwelling. So in a condo, that would be like the bare walls inn sort of a thing. In a single family detached community, that would be the home itself. And the way that these work together is that if something happens, then the association's policy comes in and covers it, but the homeowner's policy can help cover the cost of the deductible that the homeowner bears. And so the two work basically in tandem. And the association's policy might be $25,000, it might be $50,000. Sometimes associations don't involve their policies and they just deal with it in other ways, but the homeowner's policy can help cover their responsibility to pay the deductible, because it's ultimately the homeowners who are paying the deductible, even though it's the association's policy. Okay, let's keep going. Oh yeah, so a couple of examples on this. So again, this is kind of how the two work together. The HOAs insure waive subrogation against the lot and unit owners and their household members. So we had this opinion come in, Carr and Wolfstar, and there was a leak coming from outside the home into her home. And it basically rotted out the flooring and the subflooring underneath the front door. So you can see the photos here. And so she paid to have someone come figure out what was happening. They figured out it was a leak coming from outside. Outside was common area, inside was private property. And so she said, I want the association to cover the costs for me having to figure out where the leak was coming from. The association covered the cost to fix the common area. Her policy handled the interior. And ultimately what we said was, it was her responsibility because the leak was coming into her home. She brought someone in to figure out what was happening in her home. The fact that it started outside in the common area ultimately was kind of irrelevant. She still bore the costs of figuring out where it was coming from. And the rest of it they handled appropriately, with the association covering the outside, her policy covering the inside. Okay, similar one. This was in a condo, common area utility stack, a pipe basically broke, and this was inside of a condo unit. The pipe was common area, so you can see the pipe here, and it flooded the unit. And so similar kind of thing, except in this case, the association said we don't want to get our insurance policy involved, and the homeowner just sort of took care of it on his own with his policy. And we said, actually, that's not right. The association is responsible for covering the costs relating to the common elements. The homeowner is then responsible for the rest. And so the association is responsible for reimbursing him for the cost of the common elements, whether they use their policy or just pay him cash out of their bank account. So anyway, that's how that works. Let me do a time check. Okay, how are we feeling on this? Am I losing you guys? Are you good? Okay. Okay, let's talk about some closing items. Fees. Let's get into everybody's favorite thing, fees. There's a reason why we sort of leave this till the end. 4 different kinds of fees that you can see at closing. We're going to talk through each one of them and what to look for when you see these fees. First, we're going to start on the right and go left. The payoff information fee. Under state law, an association or a manager on behalf of an association can charge up to $50 for the payoff balance and account information. $50 for that payoff statement, okay? Administrative setup fees. These used to be known as transfer fees. We've made a change in the code to clarify that these are not transfer fees. This is the cost related to the sale of property that's essentially the administrative cost of handing that account over to a new owner, right? These are often charged by managers, although they're supposed to be charged on behalf of the association, going back to that. The cap is that you can only charge the actual cost for that setup fee. So if you're seeing $1,000 plus, hundreds of dollars plus, you can always send that to us because we're looking for that. But you can also ask for an itemized list of why it's costing that much, because it is only supposed to be the actual cost to get the new key fob, to set up the new account on the portal. It's not supposed to be a profit maker for the managers. And there's a new change in the code as of this year. Like 2 weeks ago, this went into effect. Any management company that collects these fees on behalf of an association has to now provide an accounting to the board at the end of the year of all the fees they've collected in the calendar year. So the goal here is to try and provide some transparency to the board to say, okay, this is how much is being collected in these fees over the course of the year. So we may see there's some big fights in the legislative settings around fees right now. We may see more happening with this, but for now, that's kind of where that stands. Those are different from reinvestment fees. I'm gonna tell you guys, if you see these mislabeled, there's a real question in my mind about whether or not you can charge a fee if you called it the wrong thing. That's an interesting question, right? So reinvestment fees, what are reinvestment fees? These are also fees relating to the sale of real property, but they're intended to reinvest into the common area funds of the association. So the idea here, the way that people talk about this, is it's like someone buying into the community. You're sort of buying in with your share of the costs of the common area, and that's kind of getting you up to speed with everyone else. There are caps on what you can charge for this, and there are changes in the code as of this year. So this is important to look for. We have new definitions here. So we have our large master plan development that we were talking about earlier, 500 acres or 500 units. There's no cap on what a large master plan development can charge in a reinvestment fee. So if you have a resort community like, I don't know, Cliff Lodge up at Snowbird or something like that, you could see a 3% reinvestment fee or a 5% reinvestment fee, whatever they wanted, if it's a large master plan development. So Daybreak, I think Daybreak probably sticks with the standard, although I don't actually know that. But
They do it within their subs. Yeah.
They do it within their subs, okay. Yeah, but technically, a large master plan development can charge whatever they want in a reinvestment fee. You also have what's called a low amenity association now. So a low amenity association would be an association that only does like landscaping or doesn't really have a lot of infrastructure to deal with. Low amenity associations can now only charge 0.25% of the cost of the home in a reinvestment fee. That's the cap. They can't go more than that. And then everybody else is the same as it's been, 0.5%, right? Now, an administrative setup fee should not be 0.5% of the cost. This is why the naming of these matters, right? And we actually had yesterday a real estate professional call us, and their client was being charged an origination fee by a manager. It was this, but it was being called an origination fee. So you kind of have to look at these and at what they're called to figure out what's happening here and what the caps are. And then the last one is the other thing with reinvestment fees, new law, at least 50% of the reinvestment fee now has to go into reserves. So we're trying to help these associations by saying if you're going to charge one of these, at least 50% has to go into reserves. Except for a large master plan community, which does its own thing. Okay, transfer fees, the last one. Transfer fees are fees that stick with the home. This was basically an idea before PIDs and before infrastructure financing districts. The idea was, let's let the developer attach a fee to the homes. So every time the home is sold, 1% of the cost goes back to the developer to repay the cost of developing and building out that infrastructure. These were actually outlawed in 2010, but there were loopholes. And so they kind of persisted. And then in 2024, they made additional changes to try to outlaw them further. And so now there are notice requirements that have to be met for any existing transfer fee to continue. And in 2026, this year, another law was changed to say if one of these is wrongfully applied or wrongfully recorded, it becomes a wrongful lien, and it gives the homeowner an action under the wrongful lien statute. So what is this? It's a 1% fee, and it's recorded against the home with the county. These are tricky because we had a company come in 2024, right after that second law was passed, and they started resurrecting transfer fees. And so they'll show up on different homes. And when you get to closing, the title companies are looking at this and they're like, well, it's recorded against your property. Like, it's recorded with the county. It's an actual covenant recorded. Like, I don't know what to do with this. You got to pay it. And because it's only 1%, people are just like, well, okay, I guess we got to pay it. Some of those are actually illegal. So if you see 1% in a transfer fee, you might want to encourage your client to talk to an attorney before paying that, because it might not actually be enforceable.
So
Yeah.
This isn't something, though, that we would necessarily see like on our closing disclosure. If we're seeing a transfer fee on the closing disclosure, it's most likely an administrative setup fee.
Probably.
The transfer fees are something that hopefully they're disclosed someplace to them, but we wouldn't even really.
It's usually title who's going to find that, right? Because they're pulling things before closing. But I don't know. I mean, they come up in weird places,
A
so
lot of times the seller pays for all these fees. And so
they can be
what I've seen-
negotiated.
Yeah, and so, but in general, what I've seen is like the seller pays for all these, and so we're not seeing on the loan side, hey. we
Oh,
have
well,
no
well then,
idea.
yeah, that's a good point. If
Yeah,
the
go
seller's
on.
paying, you might not see it.
Yeah.
Yeah.
Yeah, anyway. but,
Yeah, in the back there.
So we work in title, and that's something that you're talking about, what is it, covenant?
Covenant Clearinghouse.
Yes. I actually own rental property in the community, and because we do title, we've seen that coming in on some of the properties, like my particular property, after I saw it, I went, look, I don't have that recorded against mine. So we as a title company were like, you don't have to pay it, it's up to you, and we didn't collect on a lot of them. So we were wondering, is that really legit or not?
Yeah, I mean, some of them are, if it was already in existence before they outlawed them and they have followed all of the requirements since, they can still be legitimate. But that's why you want to get an attorney involved, because not always.
Yeah, because we saw most of those suddenly coming in like July and August of 2024.
Yeah,
And they went through and just picked a bunch of houses and started reporting.
right.
against them. So,
Yep. Mhm.
Back to the payoff fee, let's say I have a buyer who wants to buy a home and the seller is 6 months in arrears on their HOA.
Mhm.
What legally, is my buyer obligated to bring that whole? Can they go against the seller? Because I get this question quite a bit, and I don't have a clear answer. They usually end up just paying it because the HOA assesses it
Mhm.
in order to buy the townhome or the condo. What's legally really the buyer's?
I mean, so again, like it's a debt against the property. And so, Chris, you can correct me if do you want to just take it?
Want me to take it?
Sure, go ahead.
Okay, so we get this one a lot, and it actually depends on what type of property it is. If it's a condo, the Condo Act says that it is joint and several between the buyer and the seller. So it very well could be the buyer's gonna have to pay that. In the Community Association Act, though, it is identified as a personal debt against the current owner, so the seller, and against the property. So in that case, the buyer themselves does not have a personal obligation like they do under the Condo Act, but, you'd have to negotiate that. But yeah, if it's a detached home or something like that, the buyer doesn't actually have an obligation the way they do under the Condo Act.
Does title not do a search on that and say, hey, they haven't paid their HOA for 50?
You wouldn't find it in title, you would find it, you would get it
It's
from
not
the
a debt,
association.
wouldn't the title insurance that the buyer?
Go to our title person.
Yeah.
Red flag.
Yeah.
Yeah.
That's the only thing.
The fees are not recorded.
Recorded against the property. So any CCNRs or bylaws, we do pick those up,
Mhm.
and we do request those payouts from those HOA or masters.
Yeah, so like how, standing on where they are on payments, that would be something that would come from the association
It would be
itself.
on that statement that is
Yeah.
to be allocated and collected.
Yeah,
I've done tens of thousands of closings. I've yet to see a buyer pay for an HOA balance unless the seller's in a short sale situation. We saw that a lot from '08 to '11, where the buyer did cover those costs. It was all negotiated. You didn't end up paying the full price most of the time to the association because the association had filed a lien on the property, but even on condos, that's typically the case. I've personally never seen a buyer pick up that cost, again, with the exception of '08 to '11.
Yeah, I was going to say from a practical standpoint, what often happens is that you negotiate with the parties and it's usually paid by the seller, maybe in the proceeds or I don't know, something like that. But yeah, like sometimes these can be negotiated between buyer and seller at the point of sale. Uh-huh.
And then I heard a gentleman say something about whether or not it's covered under title insurance. It kind of depends. If it's a lien that was recorded against the property and the title company didn't clear that lien through settlement, that would most likely be a valid claim under the owner's title insurance policy. But if the HOA never filed a lien against the property, they may not have a valid claim under their title insurance policy. So it's really going to depend on how the HOA handled that. Back in the day, HOAs were always reluctant to file HOA liens because they didn't want to deal with the legal costs in doing so. So they didn't. They would just leave it on the account balance. But it's kind of a gray area when you just leave it in the account balance.
So I guess the buyer probably needs to have the seller disclose whether they're up to date with their HOA payments. And so if they're not gonna disclose that, then they can go back to the old seller and say,
I don't
hey.
know if that's on the seller disclosures or not. It probably should be.
Yeah, I would have to think about it.
Yeah, it's, well, we're going to get into that in just a second here. Anything else on the fees? Yeah.
Just, you had mentioned on the administrative setup fee that you can ask for that to be itemized, but I got the impression that's not the case on the reinvestment fee.
Well, the reinvestment fee is different. I don't know that it would be itemized because it's basically just like a fee and it's, hey, we're taking this and we're putting it into common area expenses, right? But the administrative setup fee, I would want to know, okay, well, like how much is it actually costing you? Like how are you coming up with $800 as the number for this if it's supposed to be the actual cost? And maybe the manager or the association says, we don't care, we're going to charge it anyway, but you can ask, right? And anyway, like I said, lots of things and discussions happening in this space right now to try and increase transparency. Okay, let's move. Okay, so yeah, let's talk about document disclosure. Wait, go back. Pop quiz. Under the law, what is a buyer required, or what is a seller required to provide to a buyer in an HOA context? Does anybody know? All the documentation, CC&Rs. Any other guesses?
CC&Rs are one of them.
Okay. What you're statutory required to provide is anything recorded with the county and, oddly enough, a link to our website. Yes. That's all you're required to provide in terms of the HOA documents themselves. Now, that's by the statute. That's state law that requires that. Under the Rep C, you might actually have more that you're required to disclose, right? So under the Rep C, you're looking at current budget and financials, board meeting minutes, the most recent reserve analysis, current rules, certificate of insurance, all that kind of stuff. But these are contractual requirements, not legal requirements. There's a difference, right? And these can be negotiated. Even though it's in the standard Rep C format or contract, they can be changed. So if you wanted to add more about, an accounting of where they are on their dues or something like that, you could add that in. But it's different, under the law, you don't have a right to this as a buyer, you have a right to that. Okay, keep going. Okay, so document production in terms of time. This has changed quite a bit in the statute over the last little while. As of this year, an association or its manager has 10 business days to provide documents. Yes?
When is day one? Is it at request? Or is it 5 days after I requested and they replied and then I start?
It's a great question. Really great question. Yep, I know. It's a great question. Yeah, it's a great question. Where this gets tricky, so the fees associated with this, if someone wants hard copy documents, they can be charged for those, but there are caps on how much someone could be charged for hard copies, or if you have to scan things in and then send it. Electronic documents, you cannot charge for that, right? So an association or a manager cannot charge for documents on a portal or documents stored electronically that they're just emailing to you. Can't charge for it. Now, there's a gray area here, because who has the right to those documents? The person with the right to those documents is the seller, because the seller is the homeowner. And the statutes all cover this in the context of the homeowner having a right to their own association documents. If a buyer makes the request, the law doesn't actually talk about that. So could a manager charge a buyer? Maybe. The law is not really clear. But the seller or someone on behalf of the seller can make the request, and you cannot charge them for the documents. Now, what happens if you ask for a rush? Something faster than the 10 days. Again, the law is not clear on this. Yeah.
So how do they get away with the HOAs docs and all these?
On a refi.
That's all.
Yeah.
So true.
And every request, I've had sellers try to request it from HOAs and had to pay the fees as well.
I'm going to ask you to table that for the time being. That's something that we're looking at.
Look at it.
We're trying. We're trying, because that is a weird loophole, right? A lot of the managers use HomeWise docs or related, some sort of related entity, and HomeWise is like that's their whole model, right? Like, yeah, charge for docs, but under Utah law, you cannot charge a homeowner, an existing homeowner, for electronic access to their documents.
Does that mean they can sue?
Or like, give us just a little bit of time.
When should we expect an update?
You'll know. You'll know.
So it
Just
seems like something's coming.
like I said, we're looking at it.
Yeah.
We're looking at it.
How do we change the 10 days?
You'll have to talk to your legislator if you want to change to 10 days. Yeah. So, best advice on this, ask early. Some documents you might want to have close to the time, but before someone lists their property, really their agent should be helping them get those documents like before they even list it. So you just don't even have to deal with this. But it is 10 days. Okay.
Maybe require the seller to disclose on the MLS these documents.
We just get it.
So then it's like, it's available, day one.
Yeah.
I mean, take care of the whole thing.
Yes.
Maybe. That's an interesting idea.
Require.
Seller gets it, listing agent has it.
It's like, if the
And
listing
they
agent
can't
can't
charge
figure
the
Yeah.
it out, if the listing agent can't figure it out, then get another listing agent.
Yeah.
Yeah, I'm going to talk to a bunch of real estate agents after this. I will not tell them you said that. But yes, that's. Okay, so let's keep going because I'm going to answer some of these questions. We're going to keep talking about this a little bit. Where does our office come in? Keep going. What we do. Oh no, we didn't actually have the. other stuff in here. Okay, well, so what do we do, right? We provide education and training. Oh, we do have the registry, that's where I was going. We can do legal advisory opinions. These are not legally binding, but we are writing them as if the issue were to go to court, how would we think a court would interpret it? And this is intended to be a step before court. It's intended to be a form of alternative dispute resolution, because the issue is that if you have a $4,000 fine, it's not worth it to take that to court to pay $50,000 in court fees, right? But it means you're also not getting it resolved. There's nowhere to go. There's nowhere to take these issues. So our office is modeled after the property rights ombudsman. They do the same thing. And through that process, we're actually identifying a whole bunch of issues where things like, is it the first day, or like what day does the 10 days start? Those are the types of things we're identifying where we can go back to the legislature and say, this doesn't actually work. Can we clarify what you want here, right? So what we don't provide specific legal advice. We are a neutral entity, and we don't enforce anything. So if we issue an opinion and the parties decide not to abide by it, we don't have an enforcement right. It's intended to be, most people do, and that really hasn't been a huge issue yet, but that's how it works. Okay, keep going. Let's skip this. Okay, so training. What I wanted to highlight. We have a checklist on our website. This QR code will take you to it. There's a digital version and a PDF, a downloadable PDF version. It is intended to be all the questions that you should ask before you buy into an association. It's 20 pages. But if you use it throughout the home buying process, once you know you're going to buy in an HOA, then it covers things like, are there fees? When was the last time they issued a special assessment and how much? Is there a PID attached to this? Are the rules, are you comfortable with the rules? Does it match your lifestyle? All sorts of things like that. So I would encourage everybody to use that. Okay, let's keep going. And then the registry, so go to the next page. This is what our registry looks like. It'll show you the president, the manager, the payoff contact. This actually is supposed to have an address and some other things in there that for some reason isn't showing. And then I wanted to point out, does it have a reinvestment fee, and does it have an administrative setup fee? These are new changes in the law that just barely went into effect. And they're there because in talking with groups like yours, people said, these fees show up at the last minute. We don't know what to do with them. It's super frustrating. So now we have something here where they have to disclose if they at least have one. Yeah?
So are HOAs legally required to be on your registry now?
Yes.
Okay.
Every HOA is required by law to register with our office and to renew that registration on an annual basis. If they don't, they cannot impose or enforce a lien against a homeowner.
And when do they have to be on there by?
Now. I mean, if they have to file, they have to register within 90 days of filing the CC&Rs with the county, if for a new development, and then they have to stay there.
So is this something a management company would typically do, or does the board?
Totally depends.
Okay.
Mm-hmm. And you might see sometimes that the manager's contact info is listed everywhere. We've had big fights over that, and we did issue an opinion that said, for that president, it has to be their contact information, but they can choose what that information is, right? I don't have a way to enforce that. But the manager can't just go in and put whatever they want. Okay, and then let's go forward. This is just an overview of HOAs in the state. No surprise where they're located, right? Wasatch Front and St. George. We've got about 4,000 that are registered with our office. We know there are some that haven't registered, but this is kind of the breakdown. And then keep going. Yeah, keep going. Okay, and then so this is our contact info. The other thing I want to say is that the state of Utah has put together a new platform. It's called myutah.gov, and it's basically a one-stop shop. So you can go in there and you can get, you can hook into the DMV to register your car. You can hunting and fishing license. Are people familiar with this?
Yeah.
Great. HOA services are now on myutah.gov. We have a whole plan for how we want to use this, but people can go in and subscribe to their HOA. We want to use that in the future as a way of sending out alerts and notices to people. So I would encourage you to encourage your clients to get on board with that when they buy a new home. Yes?
Is your office going to be helping maybe facilitate letting these HOAs or registrars know about the new Fannie and Freddie rules so that they're aware?
Yeah.
You're talking to
Yeah, I mean, that's an interesting question. We haven't really figured out yet how to, like, I want to be careful about spamming the registry, right? And sending out things that are, but we have talked about, creating a newsletter that we could send out with updates and different things are happening. We also don't have it, we sort of have a designation for whether or not an association is a condo or not. And so some of the stuff, right, is just applicable to condos. We'd have to see if there's a way where we could distinguish, so we're not sending it, I mean, really everyone should just follow it, but,
I mean, so many of them are little old ladies, right, that run
Yeah.
condo associations that have no idea that the rules have changed because they haven't
Right.
been mortgage in 10 years or 20 years.
I mean, we're finding, so we've had over 100 opinion requests come into our office since we opened. We opened at the beginning of September, and we've had a similar number of training requests come in, and most of those have been from boards. So as more and more boards hear about us, we're doing more and more trainings, and where most of the opinions are from homeowners who are frankly mad at their board, most of the trainings are boards saying, look, we're really trying to do the right thing here. We don't totally know what's happening. We did a legislative update webinar that's on our website back in April, and we sent that out to the whole registry and invited people. We had over 800 people sign up for that. So we're working on it, but again, we've been open since September. There are 3 of us, so you are seeing 2/3 of the office right here, and we're working on it. So.
We talked about Fannie and Freddie, but a lot of the condos aren't FHA approved either.
Yeah.
And that stalls obviously affordable housing options.
Right.
Is there anything in place with this new registry that can help get the boards to follow through with the process of staying FHA approved or renewing their FHA approval?
I mean, so we only deal with matters of state law. We don't deal with federal, but this is where I would look to you guys to say, do you have suggestions or requirements, right? Like putting documents on an MLS listing, like that's an interesting idea, right? So we do have a working group that we just started to explore HOA regulatory reform. That was an initiative put forward by the governor's office as part of the state housing plan. And so we're looking for suggestions and ideas. I would say if you guys have suggestions, you're welcome to reach out to our office directly or to go through these guys and send us suggestions, because we're looking for ideas. And again, the reinvestment in administrative setup fee on the registry was a direct result of conversations like this. So
I have an idea. We'll email you.
Okay, great.
Jason left, but we've had some conversations about this. So.
Okay, great. Well, that's all that I've got. I think we're out of time, but thank you all. Hopefully this is helpful.
Hey, one question. Anyone have one last question? No, good, because we're out of time. Oh, Stacey does.
The home anyway. They could always file an opinion request with our office, even though we can't do anything about it probably before you close. If we were to say, yeah, this is this was an incorrectly charged assessment, they could potentially use that to go back to the association or the manager and request a reimbursement for that or a refund. And it would be additional information for us to go to the legislature and say, here are examples. So the other option would be sending us those examples, even if we couldn't do something about it in the moment. If we had a slew of stuff that came in of egregious fees that were being charged, we can send that to the legislature and say, here's what we're seeing, here are the things that are going on, so they know about it.
And is the way to send those, is it that HOA email that you just put up there?
Uh-huh.
Utah.com?
Yeah.
Okay, awesome, super helpful.